So we want to look at taxation of business income, and today we are specifically looking at partnership business. Partnership business. Partnership business. Yes. Yeah, employment hiyo tutaangalia hiyo, lakini sasa wewe huku peana assignment yako. Sijaona. Unafaa at least umepeana nione kuna watu wamepata. Kuna watu walipata hapa. So tutaangalia hiyo, lakini wacha leo tufanye partnership business. Tusonge mbele kidogo, ndio? So we are looking at partnership business, and we want to look at a few examples. The first one was it November 2019? I don't know, I think so. Must have been November 2019. So we're doing November 2019, question number 5C, CPA. November 2019, question number 5C. November 2019, question number 5C. CPA, let me write there CPA. CPA November 2019, question number 5C. Taxation of business income, partnership business. You know what is a partnership business, isn't it? So now we read the question. Teddy, Rachel, and Michael are partners trading under the name Theram Enterprises. They shared profit and losses in the ratio of 4:3:3. The partners have presented the following income statement for the year ended at 1st December 2018. So you have the income statement, and then we have additional information. It has been the firm's practice to value the stocks at the cost price. However, the closing stock amounting to 180 was valued based on the net level value, which is 10% less of this cost price. Number 2, salaries and wages include salaries amounting to 40 paid to Rachel. Number 3, advertising include 10,000 spent on advertising campaign to introduce a new product in the market. And number 4, legal fees include the sum of 12,000 paid as parking fine and penalty to the county government. Capital allowances have been agreed with the Commissioner of Income Tax at 90,000 shillings. And number 6, Teddy's other incomes includes 120,000 shillings consultant fees. He has brought forward partnership business loss of 135,000 from the assessment of the year of income 2017. And number 7, Rachel has income of 200,000 from betting winnings. She has brought forward partnership business loss of 135,000 from the assessment of the year of income 2017. So required Roman 1, taxable profit or loss for the partnership for the year ended 31st December 2018, 8 marks. Allocation schedule of profit or loss calculated in Roman 1 above. The taxable income for each partner for the year of income 2018, 2 marks, total marks 12. So now when you are adjusting the taxable income for any business income, the first thing is you check the kind of statement given or the details provided. If you have been given the statement and they have already computed, they have given you the statement and the statement indicates either loss or profit. The way this one is, you start with that profit and you add back disallowable expenses. So here you write the name of the entity, you write here Theram Enterprises. Theram Enterprises. Computation of taxable profit, computation of taxable profit stroke loss for the year of income, 2018, and then you underline. So this one. So you can write here, you can use shillings and thousands to avoid the zeros. So now where you have been given the statement and they have computed the net profit for you, you start with that reported net profit. You start with the reported net profit. The reported net profit. So the reported net profit in this question is 1040. Are you using the 1040? So now when you have the net profit, it means their incomes for that period and their expenses, isn't it? So you go directly to the expenses and you identify those expenses that were not supposed to be deducted. You go to the list of expenses. You start with the first expenditure one by one. When you pick an expenditure, you also check alongside the additional information to see whether there's any information right to that particular expenditure. For example, we have the first expenditure here is salaries and wages. Salaries and wages, the first expenditure. So on the credit side, we have incomes, and on the debit side, we have expenses, isn't it? So the first expenditure is 280 salaries and wages. Note number 2 says salaries and wages include salaries amounting to 40,000 paid to Rachel. So it says salaries to partners is not allowed. So you add back. It was deducted here. So here you come here and add. You add disallowable deductions. We discussed about this one in details. So I hope everybody. So the first one, you say salaries and wages. To who? To Rachel. How much is it? 40. So you add back 40 here. Tumeelewana? Out of the total amount of salary paid 280, to deducted 280, 40 was not supposed to be deducted. We go to the next expenditure, rent, rates, and taxes. So rent and rates are allowable, isn't it? You can't do business without rents, isn't it? You have to do business in a rental property. Unless there is a note attached to that particular rent rates, there is no note attached to that one. So that one is allowed. Office expenses, allowed or disallowed? Office expenses, is it allowable or disallowable? That is allowable. You can't do business without incurring expenses for office. Printing and stationery, allowable. Installment tax paid. We said any payment of taxes, anything connected, installment tax not allowed. So you write here installment tax. That one is not allowed. How much is it? 45. You add here 45. That one was not allowed. And then we have advertising. Advertising is supposed to be allowed, but it has a note number 3. Advertising includes 10 spent on advertising campaign to introduce a new product. So before a product is introduced, any expenditure on it is called capital and is not allowed. So advertising of capital in nature is not allowed. Advertising. New product. New product, 10. That one is not allowed. You add back. And then interest on capital. We said interest on capital, anything that is paid for the benefit of the partners is not allowed. So you write here interest on capital. Interest on capital. So here we have 60 plus 70 plus 80. How much is that? To 10. So you write here 210. And then we have legal fees. Legal fees include a sum of 12,000 paid as parking fine and penalty. That is not number 4. So legal fees, you write there legal fees for parking fines. How much is it? 12. That one is not allowed. You add that one. We go to commission to partners. Commission to partners, not allowed. Commission to partners. That is not allowed. How much is it? 80. 45 plus 35. That is 80. We go to depreciation. Allowed, disallowed? Disallowable. Depreciation is not allowed. So you write that depreciation, which is how much? 92. So you add back 92. Bad debts are supposed to be allowed, but not to general provisions. We have no notes on bad debts, so it's allowed. General expenses is allowable. Sinikweli, we have no note on general expenses. Donation to famine relief. That is not allowed. Donation is only allowed to charitable institutions. Donations to famine relief, unless the government has declared a disaster. How much is it? 100. That one is not allowed. And then we have general reserves. You know what are reserves? Reserve, this amount that is taken from business, it is reserved, isn't it? So you don't allow that one, isn't it? General reserves is not allowed. You know what is happening here? Ukiambia watu watakuwa wanachukua pesa kwa profit zao kama general reserve, no one will be paying taxes, ndio? So everybody will just take the profit and say that is general reserves, isn't it? No one will be paying taxes. How much is it? 120. So you add back 120. And then local taxes on property. Local taxes on property. How much is it? 300. 12. So you add back there. And then we have electricity is allowable, showroom expenses is allowable. No. So when you pick an expenditure and then you check alongside the additional notes, by the time you're finishing expenditure, you'll find out that you've also exhausted the additional information. Like now, for example, in this one, we have already dealt with note number 2, 3, 4, isn't it? So we already dealt with around 4. Those are how many? 1, 2, 3. So we already cleared around 3 notes there. Then note number 1 says it has been the firm's policy practice to value the stocks at the cost of price. However, the closing stock amounting to 180 was valued based on the real. So they understated their closing stock. They understated their closing. So when you understate your closing stock, you see if there is any understatement of stocks, you just do your own simple analysis to see the impact on your profit. For example, you can just do your analysis here. For example, you have sales of 10. This is your sales. Then you have opening stocks of 4. And then you have purchases of 4 and the closing stock of 2. 4 plus 4 is 8, minus 2, 6. So your gross profit, which is your profit, is 4. That is your 4. Now you come and understate if they said you understated the stock, you just come and understate this one by any figure and you see the impact on your profit. Like now in our case, they're saying they understated what? The closing stock. So let us understate this stock by 1 and we see, is it going to increase our profit or reduce it? 4 plus 4, 8. Minus 1, 7. Isn't it? 10 minus this, 3. So when you understate your stocks, your closing stock, you have treated that understatement as what? As an expenditure, which is not, isn't it? When you understate your closing stock, the net effect is that you're reducing your profits. You're reducing your profit. So you've treated that understatement as an expense. So that one is, which is not, isn't it? So you come and do what? You add back. So you're being told the closing stock, this they set it, they normally set it, they're supposed to value it based on the cost, but they valued it based on the net realizable value, which is 10% less of. So this one, 80,000, is equivalent to 90%. So we are interested with 10% that was understated. So you write here understated closing stock. So the understated closing stock. So that one will be 10, you cross multiply. 10 out of 90 times 180. We add back. The reason we're adding back, it was recognized, it was treated as an expense. Sasa, nakuja ngapi? 20. So you add back 20. After that, you come here. And you less, now you come here less, you less omitted allowable deduction. Allowable deduction. If there is any deduction that was supposed to be done, but it was not done, you identify it and you deduct. Like, for example, note number 5, capital allowances have been agreed with the Commission of Income Tax of 90. So that is a deduction that is supposed to have been done, but it was omitted. How do I know that it was omitted? When you check other expenses for the period, it's not among those expenses, isn't it? So there's nowhere they have indicated capital allowances. So that one was omitted. So you write here capital allowances. Capital allowances. So that one you put it in bracket. If you put it in bracket, it is 90. So you put it in bracket here. We don't have any other item. And then you less non-taxable income. You less non-taxable incomes. So you go to the list of income recognized for the period, you identify those income that are not supposed to be taxed. So the first income there indicated is gross profit. That is business income taxable. Miscellaneous income is assumed to be business income. That one is taxable. Discounts received, that is business. Farming, that is income from specified. Sale on, profit on sale of shares. That one is non-taxable. Profit on, that is a profit on sale of shares. That one is non-taxable. How much is it? 100. You deduct that one. And then you less incomes from specified sources. Specified sources. What do I mean by this one? These are the other incomes. Remember, we said there are 5 sources of income in Kenya that are taxed. That is employment income, business income, farming, investment, and rental, isn't it? So in other words, you should not mix business and rental. If they are there, you deduct them. Then you will recognize them later on. So like, for example, here we have farming income. Farming income is interest on fixed deposit. That is investment. So you deduct here farming income. That is income that it should be assessed on its own. It should not be combined together with their business income. So you deduct 132. And then there is interest on fixed deposit. This one, interest on fixed deposit. That one is investment income. How much is it? 120. And then here you get the adjusted taxable profit or loss. Adjusted taxable profit stroke loss. Usingangane na hizo additional information. Wenda kwa kila expense. Ukipiga expenditure ndio unaenda kwa hiyo. So unaona sasa hii tumedeal nazo. Tumedeal na number 1, tumedeal na number 2, tumedeal na number 3, tumedeal na number 4, tumedeal na number 5. Hizo zingine ndakuonyesha vile tutadeal nazo. Sawa sawa. So we add easy and then we get this one. Can we do that one very fast? Negative 1339. So this is 1339. And then here you come here and prepare what you call allocation schedule. Partners allocation schedule here. You can just partners. You can prepare partners allocation schedule. Una underline hivi. So they come here and list, we have Teddy, tuna Rachel, tuna Michael, na unaandika hapa total. Sijui kama itatosha hapa. So here ni shillings and thousands. Shillings and thousands. So we said partners, and a partnership business, it doesn't have this taxable capacity. So partners are taxed on the gains they get from the partnership. So you come here and itemize the gains they got from the partnership. The first gain is if there is any salary that you got from the partnership business, you come here and list it here. Salary. So who got the salary? Rachel. How much? 40. So you write here 40. What else did they benefit from? The commission? Who got the commission? Commission was for Teddy and Michael, which was 45 and 35. Total 80. Then interest on capital. That is another gain. Interest on capital. Interest on capital was 60 60, 70, 80. Total 210. Right here, 210. There's no any other benefit. Mostly these are the benefits. Maybe bonus if they are there. And then you less interest on drawings. If it is there, less interest on drawings. Interest on drawings, not drawings itself. Una less kama iko. In this question, it was not there. And then here you write here, share of profit, stroke loss. And you leave here some space here. Then you adjusted profit, stroke loss. So you take this value here, 1339 here, 1339. You take this amount here, the one that you've got here. You deduct the salaries, commission, and interest. So you deduct these three items. If this was there, you add. The result that you get here, if it is positive, you share it as profit. If it is negative, you share it as loss. So you take this one, you deduct these three items. If this was there, you add. Whatever you get here, if it is positive, you share it as profit. If it is loss, you share it as, if it is negative, you share it as loss. Can we do that one? Take 1339, you deduct 40, 80 to 10, and then you see what is there. Sorry? I said you take this figure here that you've got here. Then you deduct this one first. You deduct this benefit, isn't it? If this was there, you add. The answer you get here, if it is positive, you share it as profit. If it is negative, you share it as a loss. Sawa sawa. Can we do that one very fast? So you've taken 1339, you've deducted all these. What do you get? 1009. 1009, positive. Then you share it as profit using the profit sharing ratio, which is given. If it is not given, you share it equally. So the profit sharing ratio is given, it is 4:3:3. Can we share it? Huh? 4:4. This one is 4:4. The second one, 3:3. 3:3, isn't it? Now you add this one. This is the taxable profit. If it is positive here, it is taxable business profit. So in other words, this is the profit they generated from the business. Tunaelewana? This is 5. 549. 413. 450. 418, isn't it? And then now we go to note number 6. Teddy other incomes included 120 consultant fees. And then he had brought forward partnership loss of how much? So if you had a loss in a particular source of income in one given year, you offset it from the profit in the next year. So this Teddy had a loss last year, isn't it? This year he has generated what? A profit in the same source, business, isn't it? So you offset off. So loss brought forward, loss, balance brought down. Ngapi? So hii tutasubtract hapa. Sawa. Na huyo mwingine pia nani? Rachel. Pia alikuwa na loss ya how much? Rachel alikuwa na loss ya 135, si ndio? Huyo hakuwa na loss, ndio? So tumemalizana na hiyo. Alafu hapo utakuja list other incomes. So you list now other incomes zenye walipata. So we list other incomes. So they had farming income. So farming income, unakuja unaandika hapa farming. So we don't have any farming expenses. So farming on the debit side, we don't have farming expenses. So that it means it's net. So you share it in accordance with your profit sharing ratio. 4:3 farming income. This one is taxable income. You share it. Gapi? Huh? 53, 52, 53,800. It is 132 in the ratio of 4:3. This is 53, isn't it? And the other one? 40, and then this interest income, the withholding tax for individual is final. Individuals, if they earn interest income, we said withholding tax is final. So you don't include that interest income again. So now we go to Teddy had consultants fees, ndio? So write up consultants fees. Consultants fees ni ngapi? 120, si ndio? Tumeelewana? 120. Huyo mwingine alikuwa na betting with the holding tax inakuwaga fine, si ndio? Betting. Wanatoa nani anafanyanga betting hapa? Consultants ni mmoja. So betting is not sawa. Then now here you come and you get the total taxable income. If this one was profit, uta add. Ikiwa loss, supposing you generate a loss in a business income, you don't add to the other ones. Okay? You just add the one that showed the positive figure. Sijui kama tunapatana. Kama hii business ingekuja hapa ikuwe loss, kwa mfano hii ikuwe 400, si ingekuwa loss, aunge add kwa hizi zingine, unge add tu hizo mbili, hizo ndio ingekuwa taxable income yake, 53 plus 120. Lakini sasa utachukua 549 minus hii, itakuwa bado ni positive, si ndio? Alafu add hizo zingine. So hiyo ndio itakuwa total taxable income. So the question wanted us to determine this one, we have done it. That was 8 marks allocated. This schedule, then these figures here, total marks 12. Any question? So add these figures here and then you get here. So I'm giving you around 10 minutes to write the question down before you do another question. 10 minutes or 1 minute to ask questions. Anything that is not clear. The good thing with this thing is it will be there in the exams. It's a tax zinakuanga tu vile tunafanya hivi ndio zinakuwa. Ukicheck hiyo past paper, lazima upate swali employment income, swali ya partnership, swali ya company, investment allowance, VAT na ile story ya public finance. Hata ukitaka kupata 100 hapo unapata. Juu unajua ile kitu itakuja kwa mtihani. So andika hiyo. So we can also look at another question, partnership. So December 2021 question number, no, let me see the other one. Is it September 2021? Let me see. So we can open November 2017, question number 5C. November 2017, question number 5C. November 2017, question number 5C. November 2017. November 2017. Question number 5C. CPA. CPA. November 2017. Question number 5C. So the question reads, Taylor and Lucas are in partnership operating a mini supermarket as Kialu traders and sharing profit and losses in the ratio of 2:3 respectively. The following income statement of the partnership business for the year ended 31st December 2016 should be given the income statement. And then additional information number 1, both opening and closing stock were overcasted by 20%. And number 2, insurance premium included 301 paid to insures Kiala's private car. Legal fees included parking fine, settling dispute. So you have been given note number 3, the breakdown of legal fees. Note number 4, the breakdown of sundry expenses. Note number 5, the breakdown of maintenance. Number 6, salaries and wages included salaries to Kiala in Lucas 640 and 480 respectively. And number 7, the partners took goods for personal use, which had cost 240. The gross profit margin was 20%. Bad and doubtful dates included specific provision for bad dates, 99, provision for general bad dates, 66. And number 9, capital allowances were agreed with the Commissioner of Revenue Authority as 1,574,000. Required, Roman 1, adjusted taxable profit or loss for the partnership for the year ended at 1st December 2016. And a schedule showing the distribution of partners' profit or loss for the computed in above. So you write the name of the business. You write the name of the business. Traders. So now, the first thing you check whether there was profit or loss. Was there profit or loss? Was there profit or loss? I'll generate loss or profit. Profit. So naandika pale reported profit. reported profit of how much? 2496. When you have the profit or loss, you add disallowable deductions. So these are deductions that are not allowed to be deducted. So we go to the expenses direct. The first expenditure is VAT refund. VAT. Sorry, insurance premium. The first expenditure is insurance. Insurance premium is affected by note number 2, which says insurance premium 3 paid to insurance of Kiala. So you write here insurance. You write here insurance premium for Kiala. Kiala is K there. How much is it? 3. So right there 3 or 1. That one is not allowed. You add back. The next one is legal fees. Legal fees, we have the breakdown of legal fees. Legal fees include, so we have legal fees here. You write here legal fees in regard to parking fines. That one is not allowed, which is how much? 160. And then we have the same legal fees for settling disputes. You are not in business to settle disputes. You should avoid disputes in the business. Ama, where is the best place for disputes? Court. Appeal for against tax. Appeal against tax assessment. That one is not allowed, which is 67. Breach of contract. Breach of, you know what is breach of contract? 426.6. And then preparation of tender document, that one is allowed. That one is allowed. Tender document will result into revenue. Then we go to the next one. Depreciation. Allowed, disallowed. Depreciation allowed, disallowed. So we write here depreciation. How much is it? 614. Repairs and maintenance. The breakdown is given in number 5. Fixing a broken door. Mlango imeharibika ukafix. Is it allowed, disallowed? Fixing a broken door. Okay, that one is allowed. Installation of a CCTV camera. No, camera is installation of CCTV camera. That one is capital. You are installing it for the first time. CCTV is a capital item. So CCTV, installation of CCTV. CCTV, how much is it? 860. And then purchase of furniture, allowed or disallowed? Purchase of, we said any purchase of non-current asset not allowed. How much is it? 560. So we are through that one. We go to VAT paid, allowed, disallowed? VAT paid, allowed, disallowed? If you don't know, say I don't know. Allowed, disallowed? Allowed. Can you list for me 4 expenditures disallowed? Can you list for me the 4 disallowable expenditures that you know? 4. Just give me 4 disallowable expenses you know. We said payment of taxes and any expenditure on taxes is not allowed. Another one is depreciation. Another one is purchase of non-current asset. Another one is new capital. Which other one do you know? We said you need to be, this one should be at your fingertips in regard to this unit. We said when you acquire non-carried assets, for example, a building, a motor vehicle, furniture, you partition the office, you buy a CCTV camera, you buy an office carpet, that one is not, you cannot treat it as an expense. And then when you spend money on yourself, personal expenses, not allowed, isn't it? And then any payment of taxes. Taxes include VAT, personal income tax, and any other expenditure that is connected to tax, like tax consultants fees, not allowed. Another one, you said parking fines, fines, penalties, not allowed, isn't it? And then you also said loss on disposal of non-current assets, not allowed, isn't it? And then we said legal expenses in connection to lease agreement that is more than 99 years, not allowed, among others. So those are the ones that they keep on repeating. They keep on repeating those ones. So now we said VAT is not allowed. VAT is not allowed. This is a VAT paid. How much is it? 2,000? 2,000? Is it 2,400? Sorry, it is 250. And then we have interest on capital. Interest on capital. That one is not allowed. 435 plus 197. What do you get? 632. The reason why we are adding back, some people might not be aware again. The reason why you're adding back, it has reduced the taxable income, and it was not supposed to reduce. No, not to add back. Yeah. So interest on capital na add you. And then we have sundry expenses. Another name for sundry expenses is miscellaneous or other expenses. So we have been given the breakdown in note number 4, which says it includes interest charged on hire purchase. Hire purchase. You know what is hire purchase? Ukitajua interest on hire purchase, interest charged on hire purchase, that one is allowed, isn't it? Hire purchase, it means you've acquired an asset on credit basis. Then that asset is assisting you to generate taxable income. Therefore, the interest will be allowed. Next is cash embezzled by cashier. So there's a rogue cashier who embezzled cash. Is it allowed? No, isn't it? Embezzlement by cash embezzlement. Ngapi? 6 or 2. So you add that one, that is not allowed. And then we have registration of trademark. Trademark is a capital item. So when you register it, that cost is part of that particular registration. Trademark is what we call intangible asset. Intangible asset are those assets that you cannot be able to feel, like goodwill, trademark. So any cost that is incurred on that particular is capital. So registration of trademark, registration of trademark. How much is it? 300. That one is not allowed, so you add back 300. So we go to the next one, motor vehicle expenses. Motor vehicle expenses is allowable. You are running a business, you have a motor vehicle, you have to incur cost. Custom duty, allowed, disallowed? Disallowed, isn't it? Custom duties are tax, isn't it? Tax on importation. Custom duty, yeah. Ngapi? 240? 243. So now add back here. Auditing expenses. Allowable, lakini haina notes, ndio? So naenda. Bad dates. Wametupatia breakdown yake. Bad dates, breakdown note number 8. We have specific provision for bad dates, 99. And provision for general bad dates. Which one of the two is not allowed? General provision for bad dates. General provision for bad debt. General provisions for bad debts. How much is it? 60? 66. General provision for bad debts, 66. And then we have rent and rates. Rent and rates, how much? 437. That one is allowed. It has no additional information. Salaries and wages. Salaries and wages is allowed, but they're saying salaries and wages, note number 6, include salaries too. So we have salaries and wages here, senor. So salaries and wages, salaries and wages. To who? To Kiala. How much is it? 6? 6 what? 640. Salaries and wages is 640. Oh, Kiala and Luca, how much is it? Both of them. 640 is a combination. 640 plus 480, which is 1120. And then we have so we go to the next one, which is, so we have through the expenses, isn't it? So we check both opening and closing stock overcasted by both opening and closing stock. So the overcasted. I told you when it comes to stock undercasting or overcasting, you do your own symbol analysis. You do your own symbol analysis. You do your own symbol. Hello. Hupra na mbele kidogo. Kidogo. Salaries and wages, how much? 1120. And then we said we overcast, you just write your sales 10. Opening stock 4. Purchases 4. Closing stock 2. 4 plus 4, 8. Minus 2, 6. Gross profit 4. Now they are saying, what are they saying? Opening stock was overcast. To overcast means to overestimate. So let us overcast it by 1 digit. 5 plus 9. 5 plus 4, 9. Minus 2, 10 minus. So when you overcast opening stock, you're reducing your. So we need to add back. So we're going to write here overcast opening stock. Umeelewa kweli? Umeelewa? Tumesema stock yako ikiwa 4, which is the normal stock, ndio? Profit yako inakuja 4. Lakini sasa ukiovercast hii useme hii ni 5, ndio? Inafanya nini? Inapunguza nini? Inapunguza gross profit, which is the same as tunaanza na moja, tunaanalyze moja kwanza, alafu tutaenda kwa hiyo nyingine. Si ndio? So tumeanza kwanza na hii, si ndio? Tuone hii impact ya hii ni nini? Si ndio? Si kila kitu iko independent. Ama ziko pamoja. So hii tumeanalyze hii, tumeona impact ya kuoverstate hii ina reduce nini? Profit, si ndio? So tutaenda tu add, alafu tena tukuje tu analyze hii. Hizi vitu hazikwangi pamoja. Tuna analyze kivyake. So tunakuja hapa wame overstate na ngapi? So opening stock ilikuwa ngapi? Ilikuwa 9,000, si ndio? Ama 9,000. So the 9,900, it is equivalent to how much? 120%, si ndio? Si kweli? So we are interested with 20. So we say 20 over 120 times 9, 900. So inakuja ngapi? 16? 16? 50. The same thing happened to this closing stock. Let us overstate it by 1. We want to see the impact, isn't it? So 4 plus 4, 8. Minus 1, 7. So it has the similar effect, isn't it? So you write there overcast closing stocks. And you 20 over 120 times how much? 6,000 to E. Oh, sorry. E ni overcast. E ni 3, sindio? 4 plus 4, 7. Minus 3. This is 8. 8 minus 3, 5. So it increase, sindio? So that one has been treated as an income, isn't it? That one has been treated as an income. So tutatoa. Sijui kama tumeelewana ama turudie. Tumesema wame overcast closing stock yetu na nini to overcast closing stock. The normal stock hapa, the normal stock ni 2. So when we do our operation with the normal stock, our profit is 4, isn't it? Now we want to overcast this one by any digit, and then we see the impact on our profit. So we are oversetting it by 1, so to make it 3 instead of 2. 4 plus 4, 8. Minus now the new stock which is overstated is 3. So this one now, our cost of sales will be how much? 5. So 10 minus 5. So it has increased our profits, isn't it? So in other words, this overstatement is treated as an income, which it is not, isn't it? So we're going to deduct it. So overstating your closing stock, okay, hata hiyo tunatumia tu logic. Sema wewe uko na vitu mbili na umeongezea ingine moja. Sio ingine umeongezea hiyo ni kama unajiongezea pesa yenye hauna. Si ni kweli? So hiyo utatoa, si ni kweli? Hiyo tumemaliza. We go now, we are through with the, and then there is note number 7. The partners took goods for personal use, which had cost which had the cost price of 240. The gross profit margin was 20%. So they took goods of 240. So now the cost was 240. And the gross profit margin was, so this cost price 240. The selling price, it will be 25 over, is it 20, isn't it? It will be 20 over times 240, which is 60. So the selling price will be 300. So it means you're going to add back 240 as drawings. And then they also treated it as income or sales. We're going to deduct 300 from the sales side. This one was, drawings is not allowable. You are not allowed to take goods from business for your own personal goods, isn't it? For your own personal use. So the cost of the drawings you take, it's supposed to be added back. The cost of the drawings, isn't it? Sales. You also sales. If you take goods for your own personal consumption and you treat it as sales, it's not income. That one is not income. So we're going to add here drawings. Drawings of how much? 240. And then this 300, we're going to deduct it as non-taxable income. So we are through with that one. We are through with the expenses. Anything that is not clear? And then now we less here omitted allowable deductions. We less here omitted allowable deductions. We less omitted allowable deductions. So where do we get them? Number 9, capital allowances were agreed with capital allowance. So we write here capital allowance. Capital allowance. Capital allowance is how much? 18. So this is omitted. And then we less non-taxable income. Non-taxable incomes. We start with these drawings. This drawing is here, 300. We deduct it here. Huh? Nini is 74. Alafu tuna less overstated closing stock. That one is non-taxable. Ilikuwa overstated na ngapi? So itakuwa 20 over 120 times 6,200. That one is not, we less that one. How much is it? $10.33. We go to the list of incomes given. We have VAT refund. VAT refund, that one is not. VAT refund is non-taxable income. How much is it? 110. Dividend income, profit on disposal, not taxable. Profit on disposal. Profit on disposal, non-taxable. How much is it? 1576. So this one you deduct them. You put in them in bracket. And then we less income from specified sources. Income from specified sources. Income from specified sources. So we have dividend income. That one, dividend, which is how much? Is it 600? And then rendo income. Rendo income is how much? 1917. By that time, unaona tumesha deal na note number 1, tumedeal na note number 2, number 3, number 4, number 5, number 6, number 7, number 8, number 9. Tumemaliza kila kitu. So hapo utapata adjusted taxable profit or loss. Adjusted taxable profit stroke. Swali. So add easy. Can you add all this? Subtract this one. Put here before we look at the schedule. So how much do you get here? Huh? 35, 93.6. And there you come and prepare allocation schedule here. You prepare allocation schedule or distribution schedule. So you come and allocate, you give them allocation schedule. So we have who? How many partners are they? Two, eh? We have K and L, and here total. So here shillings and thousands. So shillings and thousands here. You can write here shillings and thousands. It is okay. So shillings and thousands. So we start with the gains they get from the partnership. So the first gain is salaries. So you give them their salaries. Salary, this is 640 for 8, a total 11, 20. Interest on capital. Interest on capital, Kiala, for 35. Naya, 197. Total, 632. Any other? If you had interest on drawings, you less interest on drawings. Interest on drawings, if it was there, it was not there. Then here, share of profit or loss. Share of profit stroke loss. Then you leave some space here. They write adjusted profit. Adjusted profit stroke loss. So here you take 3593.6. And then you deduct these two items. What do you get? 1821. 1841.6. And then you share. Huh? 736 point. This one. 736 point. And this other one. And then you add downward. And then here you come right here, other incomes. Other incomes. So these are the other incomes here. Dividend income for individuals. If they just write dividend income not from cooperative society, withholding tax fine. So you don't add there again. Rendo income, you come here and add rendo income. You share it in accordance to here. So you share that 1917. You share that 1917. Share. Huh? 1150, this one. Second one, eh? The first one, 766 point. And then you get the total taxable income. Total taxable income. So una add hizi hapa alafu una add zote unapata hivyo. Tunamaliza. So hiyo swali unafanya hivyo. So we are through with that question. Any question so far? Nani hajaelewa? Ni nini hujaelewa? Yote. Tutakunulia lunch kwanza. Nani mwingine hajaelewa? Wewe umeelewa kitu? Na wewe? Nusu unamaanisha nini? Na wewe? Dividend tumesema dividend kwa individuals, withholding tax ni final. Ile tax unalipa at the source ni final. So hawa ni individuals. Au ongezei hapa tena. So ile tax walipa iko final. Interest pia hiyo withholding tax ni final. Interest kwa individuals. Sawa sawa. So assignment. Jaribu hii swali. Unajaribu unaniletea. Usikae nayo. So jaribu May 2021 question number 5C. May 2021 question number 5C. Assignment. May 2021 question number 5C. May 2021 question number 5C. So si utanisainia hii. Niletea. Alright. Una swali? Gani hiyo? Unge-add pale vile ume-add kwa re. Kama ingekuwa andika gross unashare hivyo tu gross. Kama imeandikwa net una gross. Kama imeandikwa gross unashare vile iko. Lakini huwezi kuandikia gross. Unaweza nyamaza ama kuandikia net. Sawa sawa? Una gross, unapata gross amount ndo unashare. Ndo ana hapo. Sawa sawa? Nakuja. Kazungu.
Kulingana na timetable, kama lepa zako ziko valid, unakutumia link, unatumia sisi kufika, unajoin na kuwa sasa kufikia wenzako. Una advance tax pia. Niangalia hapa kidogo tu. Unanipata? Kata simu kuangalia tu hapa sasa. Okay, kuna leadership, kuna FM, ndio, alafu kuna advance